All right, everyone, welcome back to Build a Profile Module 9. What are options and how to trade them? As always, I want to remind you that there is risk involved with trading and investing, and you'll be mindful and wise to consider the risk. Past performance is not necessarily indicative of future results, meaning that just because you have an edge at one point doesn't mean you always have that, so you always have to be mindful of the risk and protect your capital. In this module, we're going to talk about what are options and how can you incorporate them into your trading and investing. Lots of cool things to think about around options. And what are they exactly? Well, options are a contract, or think of it like a coupon, a ticket between two parties that are thinking about a future exchange. So they're looking at some underlying asset, looking at some point in the future, and they're saying, hey, I'm willing to buy or exchange that asset at a certain price. They do control an underlying asset. Now you can have options on futures, you can have options on stock, you can have options on Forex. For the purpose of this module, we're just going to focus on options on futures and stock. The Forex is a whole other ball game, and you can apply the stuff in this module certainly to explore further, but we're going to focus primarily on futures and stock. So they control an underlying asset. So one contract or one option contract in the futures side controls one futures contract. On the stock side, it's 100 shares of stock. Key distinctive there. And it's a means of insurance against an underlying stock or commodity. You can use it as a hedge. In fact, that's the reason that they initially came onto the market, was a way to express a form of insurance against and protect the investment that you had. And that's where some of the pricing comes in around that, is because of an expectation of movement and what people are pricing in, what they'll say, quote unquote, pricing in risk. But what has been determined is that as people have bought these contracts and shared these coupons, the coupon itself has value that changes, and that change in value can allow you to just trade that paper and express an opinion on an underlying asset that may be out of your reach financially, but it still allows you to play in that game. They move in ticks on futures or cents for equities, and they appreciate or depreciate based on the perception of value and economic fundamentals. It's essentially saying we have no idea why prices move up and down. There's all kinds of things baked into the price movement. And as behaviorists, we don't really care. We're just looking for opportunities around consistent expected behaviors. And there are some expected behaviors around options that help us make better decisions. And the position is established through the use of margin and leverage. We're going to spend a lot of time talking about that. Okay, how do you profit? How do you lose? Well, you'll initiate a position much like a futures contract, because an option is a type of future as well. So you can actually buy to initiate, or you can sell to initiate a position. And then appreciation or depreciation is based on the change in the contract price. So ticks or cents, and the selected strategy. Selected strategy being key in that there's lots of ways that you can compile positions in options that are more complex than just trading stocks or even futures outright. That's why we're talking about options after we've talked about the other two. Commissions are typically based per contract, not per trade. So if you want to put a position on, if you want to trade 10 contracts, you're going to pay a commission for every contract. Now, there are some brokerages out there that are beginning to offer what they call free commission option trading. It's actually not free. They're capturing something between the spread of the bid and the ask. So they are still charging you for it, but they are reducing your cost, and that makes it more attractive. But know that it's based per contract. As opposed to when we talked about stocks, if I buy 100 shares, it costs me the same as if I bought 4 shares. In options, if I buy 100 contracts, it's going to cost me different than if I trade one contract. And profit or loss is determined by the number of contracts times the position, entry price, plus or minus the current price. Okay, so benefits and risks. Benefits. Well, leverage is a fantastic benefit. The fact that you can express an opinion on some underlying instrument for less money. You don't have to. It's a great way if you're lightly capitalized to participate in market or use your capital very efficiently. So you don't have to have as much money to open an options trading account. I've seen people open options trading account with as little as $500. I personally would not recommend less than $5,000 if you want to be fairly active. But you don't have to have a lot of money, not like $50,000 to trade futures or $100,000 if you're going to trade stocks and such. So very, very much more accessible. They offer opportunities around diverse timeframes, meaning you can express an opinion around today, tomorrow, next month, next year, even if you wanted to, depending on how active that you want to be. They offer the opportunity to define your risk. What do you mean by define risk? And this is a term that you'll find often, is saying how much am I willing to risk and where would I know that I'm wrong? And it goes back to those 4 questions that we asked. In an option, some strategies can allow you to say, hey, the maximum I will lose on this is $50, and I can put that position on and either does what it needs to do or I lose the $50. Like, it could be like that. You can define the risk that way. There's lots of products that you can trade and an express opinion on lots of different instruments and sectors. And if you want to just trade tech companies, if you want to trade healthcare companies, if you want to trade specific sectors like real estate or energy, you can express opinions on lots of different things based on your taste or your interests. That's kind of fun. And strategy diversity. There's lots of different ways that you can compile these positions using options that you can't do just trading stock or futures. So, and we're going to talk about some of those as well. And they can be liquid, meaning you do have to do a little bit of your homework, but you can find options that allow you the opportunity to get in and get out without significantly impacting your entry or exit price. Now, some of the risks, just like leverage, this ability to express an opinion with less capital is a benefit. It's also a risk, and we want to be mindful of that. In fact, one of the strategies allows you to sell what we call sell at premium, and this is selling a position without owning some underlying thing that can actually set you up to an quote unquote unlimited loss if the trade goes against you. And what we talked about in futures, the idea of a margin call, where you actually have to pay up the broker to hold the position. That's something to be very mindful of. Expiration is also a risk. So because just like futures, they have expirations that occur at different intervals, and these expirations sometimes can be the next day, can be multiple times a week. So you can have expirations midweek, weekly, monthly, quarterly, and so forth. I actually lost a very, very substantial amount of capital once because I bought the wrong expiration date. And then I went through expiration. Guess what? If you have the position and you get into expiration, you don't get out of it before that, you lose everything. So being very mindful of expiration and where you are is a risk. Strategy choices can be a risk because there are so many different ways that you can express opinions using options. It can induce this type of style drift where you're like, oh, well, you know, this type of approach didn't work, so I'm gonna try this other one. And then you end up going from strategy to strategy to strategy and not really ever being successful. So while there's all kinds of cool ways to express opinions using options, best to keep it simple first and then expand out, this is part of the risk of the learning curve. And it's why also we're talking about options now in Build a Profile. We didn't start with them. I actually started with options fairly early in my trading, and it caused lots of confusion and things I had to unlearn because I didn't understand where they fit in the broad scheme of markets. So hopefully this will save you a lot of time thinking about this up front. Selecting options products or selecting options. Well, some nomenclature for you to be aware of. One is calls. So a call, somebody will talk about a call, and that is the opportunity to call away a future or a share from someone at a quote unquote strike price. So if I'm going to pull up what we call an option matrix here, and I'm going to look, this is Apple stock. So here is the stock. Here's what Apple is currently trading at. And then these are strike prices. Okay, so if I can buy the 195 April call, $2.16, and I can basically, I'm buying the opportunity to call away Apple shares at 195. And I'm paying $2 for that opportunity. So that's the opportunity to call that away. If I wanted to buy a put, I could buy the 155. I'm buying the opportunity for someone to sell it to me at 155 for $1.32. So these are calls and puts. So call is the opportunity to call it from, the put is the opportunity to put that share at a strike price at some point in the future. Now you can elect to what we call exercise that option at expiration. 90% of options go unexercised, they expire worthless because no one actually did it. They were used as a insurance up till the point of expiration, and then people get out of it. Now, something to be mindful around when you're selecting options is also the fact that they have a notional. They control something bigger than themselves as part of the leverage, is that equity options control 100 shares, and futures options control 1 futures contract. So just know what you're controlling, because some strategies you actually want to take control of the shares or the future. So you need to know how much capital I need to have to cover that. That notional allows you to do that. Okay, option terms. Some additional terms that are going to be helpful for you. One is intrinsic value. Okay, this is the difference between the underlying stock or future price and the strike price, and the other is extrinsic value. So this is an additional what we call premium that's between the market price of an option and its intrinsic value. Okay, let's compute this just so you have an example of what this looks like. All right, as we said, Apple's trading 177. The 180 call is trading at 670. Now, if we bring up a calculator and I take 180 minus 70, it's 173. So it's greater, there's a greater difference between 177 and 180. So what's happening? So if I just take 180 minus 177.44, it's 256. That is the intrinsic value. That's just the absolute difference between the current, the market price and this price for that strike price. That's what it should be. You know, like if there was no additional expectation, it would just be $2.56. So the fact that it's more, that it is 670, says that there's close to $4 of extrinsic value. It's above and beyond that strike price. That's intrinsic value, extrinsic and intrinsic value. Other terms to know, the Greeks. Okay, we're not. If you don't know any other Greek, know this one. It's what we call the delta. So delta is how much an options price is expected to change per $1 change in the underlying stock. It's actually the probability that that strike price will be in the money when we get to expiration. So going back to my matrix here, we've got 88 days on this April 20 thing, and the probability that we'll be trading 180 88 days from now is 47 cents. That's the delta. That also means that if Apple moves $1 today, this call will change 47 cents plus or minus from where it's trading right here. And because it's 100 shares, the 47 cents becomes $47. Okay, so it'd move $47 for every $1. So for $670, I could, or $680, I could buy this immediately, because if I want to get in, I just buy the ask. So $680, I could buy it. And then for every dollar move Apple makes, I could make 47 bucks. Pretty cool potential return, reward risk ratio for return on capital. Hey, but that's the delta. And you'll notice that the closer we are to where we're currently trading, the higher the delta. And for the strikes that are actually below where we're trading on the call side, a much higher delta. These, because they're higher than where we're trading, we don't know. There's a very low probability, and they won't move as much. Same thing on the puts. They're below. How likely is it that we'll be trading at these prices? Here's one of the cool things about options, is that because they're a two-sided market, these puts and calls, I can actually predict in the future the range that something will be trading with about 95% probability. How cool is that? So like right now, 88 days from now, most likely Apple's going to be trading between 150 and 205. It's a $55 range. There's a 95% chance. How do I know that? Because look at the delta of the 145 call. It's 5%. Look at the delta of the 210, 8%. It's around 13% chance. You subtract that from 100, you get 87% chance that we're going to be in this range between now and this April expiration. Very, very cool. Okay, 40 cent Delta 40 means that options price will theoretically move 40 cents for every $1 move in the price of the underlying stock. That's the delta, and that's the current price. It's good to know. Now, after the delta, we go to gamma. Gamma tells us how much will the delta change per $1 change in the underlying stock. Because the probabilities change as the underlying changes, that delta is going to change. So it's the probability that the probability will change. Not as big of something to think about as the delta, but it's something to be aware of. So for example, if you buy something that's out of the money, so say for example, I think Apple's going higher, and I want to buy this 200 call, which currently has a 15% delta. Well, if Apple goes up $10, this delta is not going to be the same. It's actually going to increase the rate that this thing will gain as we go higher. So that can be a cheap way if you really have a belief that it's going to go in that direction. Know that that will change. Theta. Theta is also a key Greek to think about, in that theta says how much will the extrinsic value contract, or the premium of the contract contract as we get closer to expiration. What's the rate of change? So as I look at this, see the theta here, okay? For every day between now and April that we don't get to 180, this thing's going to lose 4 cents, because the probability is getting tighter the closer we get to the date, because we're going to this future. We'll know closer and closer, hey, this is where it's going to be or not going to be, more likely, and so that thing will decay. It's its price where it is right now because we don't know. And then Vega. Now, Vega is not, it's not actually a Greek letter, but what it does do is it's telling you how much an options price should move when the volatility of the underlying security or index increases or decreases. Now, I'm not going to talk a lot about the specific Vega, but we're going to talk about this idea of implied volatility. This is a term to be aware of, and we're going to talk about it now. So implied volatility, as you see here, it's the theoretical, it's the expectation of how price is going to change going forward. Now, nobody knows. When we look out in the future, we don't know what the price will be, but because we have all of these participants in an efficient marketplace who have guesses, we could come up with some degree of an expectation, theoretically, on what that range will be. If there's an expectation of all those who participate that it's going to be a bigger range, because there's more unknowns, could be, if it's a company, there could be all kinds of financial turmoil in the company, there could be economic impacts, things like that, then the implied volatility could be higher. This is a forward-looking instrument. Implied volatility is looking at how much do we think it's going to move in the future. That's the implied volatility. Great metric, because it's the thing where that is. If we think it's going to be wider, you're going to have a wider implied volatility. If we think it's going to be smaller, you're going to have a smaller implied volatility. This is important for us as options traders because it allows us to check boxes on which strategies do we employ. So if you have a high implied volatility, periods of high volatility are almost always followed. Let's go over here. So if I look at, right pin, I look at time, and I have a stock that has low volatility, if I'm going towards an event, periods of low volatility are always followed by periods of higher volatility. And periods of high volatility are always followed by periods of low volatility. Why is this? So once we get past the event, the expectation of movement contracts. So you'll often see implied volatility increase going into earnings reports. Why? Because we don't know what's going to happen. And then after earnings, they'll decline. Why? Because we knew what happened. Okay? So the strategy that you pick, so if I'm going into earnings, I want to be in a strategy that is expecting the volatility to increase and benefits from that. And if I'm at earnings, or I want to be in something that's expecting the volatility to decrease. This helps me select some of my strategies. So when it comes to finding opportunities, you can do premium selling. So this is when volatility is higher and you're looking for it to contract, you can sell an option and collect as the theta decay plays in. Or if you're expecting it to go wider or stay the same, you can do naked options, and you can buy an option or buy a call, buy a put, looking for that volatility to expand. If you're looking for something that's non-directional, you can do things that are a combination of calls and puts together, something called debit and credit spreads. This is a way to capture a range of probabilities with respect to volatility. I'm not going to spend a whole lot of time on that. Feel free to dig in on those. And you can also create what we call synthetic stock or futures. So for the futures example, for example, if I buy an outright contract in futures, there's unlimited upside and there's unlimited downside. Okay, well, if I buy a call, there's only the premium that I paid for the call. So if it goes down, there's no, it's just done. If I want it to act more like a future, I could buy a call and sell a call, which gives me the opportunity to see unlimited to the upside and unlimited to the downside, but at a much smaller price of entry than buying the future or the stock. So one of the reasons that people do a synthetic stock or future is because they're trying to do a more efficient use of capital. And then there's really wild things like iron condors, butterflies, and jade lizards. This is similar to debit and credit spreads, but basically what this is looking at where an option is and what the volatility is and building a position through an amalgamation of calls and puts. I'm not going to spend a lot of time on them. They're very complex. This is part of the risk of options. It can be very complex. You can feel free to dive into those on your own. When you're looking for opportunities, just again to reinstate, you're looking at the underlying, whatever the instrument is, you have the current price, and then the strike price is here. You have calls on one side, puts on the other, and then those calls that are at strike prices below where we're currently trading, those are called in the money, meaning it's most likely that we're going to be at that price or higher at expiration. Same thing for the put. We're going to be at that price or lower. So if I'm below the strike price, the put appreciates. If I'm above the strike price, the call appreciates. And you can also build watch lists that include the Greeks, where you can watch all of those in real time and build watch lists to be able to select those opportunities. Now, I do want to point out a couple option favorites that I like, that I look for whenever I'm looking to express an opinion. One is called selling cash secured puts. So let's look, for example, at, let's just pull up Frontier Communications trading at $8.47 per share. Okay, let's say I want to own Frontier Communications, and I want to go out about 53 days. Okay, and currently it's trading at $8.47, but I'm looking here at the $7 strike right here, and that's trading at 45 by 50. That's the bid and the ask on that. I could sell it at 45 cents or $45. They're gonna give me $45. Now, because it's cash secured, I basically, and it's because it's controlling 100 shares, I have to have an $848 because that's the current. So for $848, I can sell the $7 put. What this means is that if we're trading below $7 at expiration in 53 days, someone can put those shares to me at $7. Sell this right now, and if we're trading at 7 or below, I get them at, I have to buy them at $7 minus the 45. So not actually, I would buy them at 6.23 if we're trading below $7. If we're trading above $7 by expiration, I will just keep the $45. So this is actually the way that Warren Buffett buys stock. He never buys the stock outright. He sells puts. He'll sell puts, and at different strike prices below where it's currently trading. And if it's below those, that's where he'll buy them. But he's also getting them with the premium. So using the options to buy that. Here's the cool thing: is if you're trading above that strike price, you just get to keep that premium and go home. Now, if you really wanted the shares, then you don't have the shares, but you still get the premium. And you keep doing that over and over again, looking for those types of opportunities. So cash secured puts is a great option per trade that you can look for. If you're looking for to get into something directionally and you don't want to buy it, you want to get in even lower price than where it's trading right now, you can use cash secured puts. Second is selling covered calls. Okay, let's go back and look at this same example. So let's say you own Frontier at, well, say you buy 100 shares at 843 or 846 right now. Okay, you can sell the $9 call for 40 cents. So if we're trading above $9, somebody would want to call that share away from you at $9. Well, they could get it for $9. And if you're having it at 840, that would be basically 50 cents of profit plus the premium that you sold. Now, here's the cool thing. If we're not trading $9 at expiration, you get to keep that $40 and you can keep selling it. Now, to do this, you have to have 100 shares of that underlying to sell, hence the covered call, you're covering it. But this is a great way, especially if you have a good cost basis on your shares, you can keep selling premium over and over, month after month, and make income this way. Finally, defined risk directional positions. So this is where you're actually just buying a put or a call, and you're looking for that share to go in one direction or the other. If we look over here at Apple, for example, and we've got 175 is a key volume node. If I could get down to 175 and hold that level, I might buy a call and look for Apple to, so wait for it to come down here. Here's a level that I'm interested in buying, and then let that thing go higher. If we come down here first before testing this level, that would be my target. So I'd look for about a $3 gain. So if I think, okay, $3 gain, say I bought something that had a 50-cent delta, so $3, that'd be $150 in potential profit on one contract, buying and trading Apple. So those are things to think about. You can use the profile as a way to trade options. You can just buy that contract outright. They're very cheap, but know that theta is something to think about, and also know, hey, where am I wrong to get out? Okay, homework. Homework is to find a liquid stock in or future. So liquid would be 1 million shares a day traded. Liquid future would be over 100,000 contracts traded. And you're going to find an option strategy. Start with a directional, and determining whether that strategy is directional or not. Now, you're going to pick a strategy. If you're more advanced, you can do something less directional, but start with a directional and find opportunities and place trades. Now, if you don't have a brokerage account, one of the ways that you can do this is to go to investing.com, and you could look at a stock like Apple, and you could pick on options, and you could pick an expiration. So let's say April 20th. I could say, I believe Apple's going higher. I'm going to buy the 175 call. I'm going to pay $9.15 for it. Mark that down. Come back later, see what that price is, see how that appreciates. That's a way to see that. So find opportunities, place trades, record your performance, expressing those on options. Next steps, review the video, complete the homework, proceed to the next module. As always, if you have questions, send me a line, josh@tradesprofile.com, or give me a call. If you want to learn more about options specifically, there's investopedia.com, CBOE, which is the Chicago Board Option Exchange, lots of resources there, more educational, and where you can really expand your knowledge. Investing.com, again, just like we showed, you can see the specific strike prices. If you don't have a brokerage account, tastytrade.com is a fantastic resource specifically for non-directional option strategies. And if you're looking for things that like premium selling and stuff like that, great resource. And then also TD Ameritrade. The platform I just showed you is Thinkorswim from TD Ameritrade. You only get that platform if you have an account with them. They have great paper trading that allows you to practice trading options and stocks and futures. And I keep an account with TD Ameritrade just because of the options tools, purely for that. I don't endorse them. I'm not paid for that. It's just a good tool where you can get more information about options. All right, that's Module 9. What are options and how to trade them?